that's why if you understood Bitcoin, you would never say something so silly as I know when to buy it and I know when to sell it and I just trade. The people that are trading in it don't really understand it, because if they understood it, they would just buy it and hold it. And then sometimes people think they're accomplishing something, but they're accomplishing not that much. Like if 100 entities buy $1 billion each, then the value of the network is going to go up by more than $100 billion. And if they just buy it and park it in a cyber vault and don't touch it for 100 years, it doesn't matter. It's going up, right? It's that the fact that they poured their energy into the container is actually what caused the energy network to grow. The moving in and out is actually wasting and dissipating energy. You know, you're just dissipating energy to come and go, and ultimately, the success of the thing is we've got. I hear these people. They talk about store of value, medium, and exchange. Well, Bitcoin is a high frequency store of value and a low frequency medium of exchange.
Right.
That's what it needs to be, and technically, that's what it is. And if you understand that, once you get it, you realize you shouldn't fight that. So, for example, I buy $1 billion of Bitcoin. Every second, it keeps anybody from stealing my Bitcoin. Every second, it's storing the value. No government, no parasite, no thief, no hacker is taking my $1 billion. So every second for the next million years, it's working. In the same way that I put that energy into a vacuum package, and every second it's staying vacuum sealed. And the whole point was to live forever. And so if I gave you a little crypto feel that made you live forever and never age, you would say high frequency longevity device. It works pretty well. And you wouldn't have a problem with it. There's nothing wrong with living forever. It's immortal energy. So that's high frequency. The problem is people don't recognize that every second of the day they're being attacked. You are being attacked, by the way. Every second of the day, there's bacteria and there's viruses trying to kill you. If I said, I'm going to spin up a field that stops them from killing you, it's going to work 1 million years and you're not going to notice it, you would think that's a pretty good trick. But that's, in fact, what happens when you actually store value. Now, low frequency medium of exchange, in order for Bitcoin to have its anti-fragile properties, and for it to have utility, we have to be able to move it on occasion. Maybe once a year, I move it from one cyber crypto bank to another one, or one cyber vault to another one, or once a decade, or maybe when I'm going to die, I need to transfer it to somebody or split it between my daughter and my son. Or maybe not. Maybe I just have one key and I give it to my one child. They give it to their one child. They give it to their one child, and it never gets transferred. But maybe once a year, I have to take 5% of my Bitcoin out of my vault, convert it to fiat, and then break that into 100,000 little parts and put it on Apple Pay and use it to pay for Ubers and Domino's Pizza and credit card bills. Okay, once a year, I take a chunk out of my piggy bank, my crypto bank, and I put it into fiat, and I do whatever I'm going to do with it, right? Maybe. And maybe if the world works the way you think it might work, I just put $100 million into the vault. I never take it out. I just borrow against it. And I borrow, I just borrow $3 million a year, $1 million a year, tax-free. I don't recognize income. I don't generate a capital gain tax. I don't generate an operating income tax. I don't, if I borrow money in cash, and if my Bitcoin is going up 20% a year, if that's the real yield, and I can borrow money at 5%, then my effective arbitrage is 15%. So it never makes sense to sell it, ever.
Right.
In fact, if you look at people that use real estate as a store of value, the way it works is my family buys a block in Manhattan for $100 million, or they buy it for $10 million in 1900. It goes up 8% a year. It doubles every 10 years. It's worth 20 million, then 40 million, then 80 million, and then 160 million. And by the time you get out 80 years, you got $1 billion worth of real estate in Manhattan. You're not selling it. You haven't done one transaction in 100 years. All you've done is pledged it as collateral against a loan, and you borrowed $42 million against it, and you're paying 3% interest. And that $42 million, that's not income. You didn't pay 40% tax on $40 million in income. That's not a capital gain. It's not a long-term capital gain. It's not a short-term capital gain. It's a liability. You've generated $42 million of liabilities against a non-taxed asset. The only way it's getting taxed is you're suffering from real estate taxes, right? Yep. But you can see if you're in a jurisdiction where inflation is high, real estate tax is low, interest is low, then your secret to living well forever, tax-free, is just borrow against your stationary assets. And so, and that's the news that's the news of this week, right? Donald Trump has $400 million in debt and paid no taxes for a decade.
Right.
But he's not unique. You could substitute every real estate magnate, a family that had generational wealth in real estate. They all did it.
Yeah.
All of them. That's, how do rich people live well and pay no taxes? Not by selling stuff.
Right.
Not by transacting stuff. The way that they actually live is they just park an asset on the balance sheet and they never, ever, ever, ever trade it. They just finance it or borrow against it. And then once in a blue moon, once in a decade, somebody wants to pay me triple what it's worth. And maybe I do it, but oftentimes, the Warren Buffett school of thought is the taxes kill you. And so the ideal holding period for an asset is forever.
Right.
And it's not just, he says it's forever because I'm committed to it. Yeah. But it's the taxes that murder you. And so the ideal holding period is forever because then you can pledge it and borrow against it. And how do you get rich? You buy an asset, it goes up, you borrow against it to buy another asset, and it goes up, you borrow against it to buy another asset, and it goes up. And pretty soon, you've generated all these assets that are highly appreciated with massive built-in capital gains that you're never, ever going to recognize.
No.
Obviously, that can change in different tax jurisdictions, or the politicians decide they're just going to tax you on unrealized capital gains. But
let me ask you, how do you balance that with the not becoming fragilized by leverage? Is it just kind of a threshold that you would keep it? You'd never borrow more than, say, 10% of the value of the collateral, something to that effect? Is that how you protect yourself?
The fragility comes from two primary metrics: collateral coverage and the mark to market, the frequency of the loan, the duration of the loan. How frequently is the collateral marked to market? So, for example, if you borrow money to buy a house and it's a 30-year mortgage, and if the bank says to you they're never going to they're never going to mark it down, right? There's some loans like a mortgage loan where they'll never get marked down. They might get marked up. You can go to the bank and you can petition them to revalue your loan, but nobody ever went to the bank and said, mark my house to the market after the real estate market crashed.
Right, sure, yeah.
So if you buy $1 million house with a $800,000 loan, right, and you've got $800,000 in debt, and it's never marked to market, then there's not that much fragility as long as you can make the $25,000 a year interest payment, assuming 3%, right? So that's not that risky. I mean, a little bit risky. You can't make the $25,000, you lose it. But on the margin, if I didn't have the $1 million, or I didn't have the $800,000, and someone's going to give me the $800,000 house for free, and all I do is pay $25,000 a year, I think that's a pretty good trade-off. And the worst that happens is they take the house back, and I go do it again somewhere else. So that's not very fragile. How does it get fragile? It gets fragile when you buy $1 million house and you pledge, well, actually, it gets fragile when you buy $1 million worth of stock on $800,000 loan, and you've got loan to value of 80%. And now the stock trades down 20%.
Right.
And the stock trades down 20%, and the banker marks the collateral every day. Mm. And if you're in a swap with a bank, they will market to market every day. Every single day, they calculate the value of collateral, and if you're under, you have to wire them the money the next day. And if you're over, they in theory have to wire you the money, and you have to market every day. That's risky. And of course, so if you were going to buy stock, if you're going to buy $100 stock, you probably don't want to borrow more than 50%. But if you borrow 50%, you damn well better think that the volatility is not going to be 50, right?
Right.
You can't afford to. So probably in that case, if you thought the volatility could lose half its value, you want to borrow no more than 25%. Right. And if you want to be able to hold the stock, even if it loses 80% of the value, you can't borrow more than 20% loan to value, right?
Right.
So the big risk, the hyper risk is like one of these Bitcoin exchanges. I go 100 to 1 leverage and I mark to market every hour.
Right.
What if I mark to market every minute, Robert? Right. I mean, that's the BitMEX liquidations. Right. I basically bought 100 Bitcoin. I pledge 1 Bitcoin. It gets marked to market every minute. And if the price goes down $100, I get wiped out and there's a crash. Right. And it happens in 3 seconds. So that's risky.
Yeah.
If you want to take the opposite point of view, I have 100 Bitcoin, and I'm going to borrow the equivalent of 1 Bitcoin in value or 10 Bitcoin in value. And as long as it doesn't go more than 90% down, I'm good. But if you wanted to stay for one, you would say, I'm going to borrow against the collateral, but I want you to agree that you won't ever market to market. Mm. That's what real estate loans are.
Right.
Or like a bank. I'm going to loan you money against your artwork or against your boat or against some other interesting collectible. And every year our appraiser is going to reappraise it, or every 5 years. Right. So it's the issue is the frequency of the appraisal.
Right.
Combined with the volatility of the asset, combined with the political regime you're in, combined with the loan to value. If you're in a political regime where it's unacceptable to let real estate values go down, then you can reasonably expect that it's not likely your house is going to be worth 20% of what you bought it for, because the politicians won't let that happen. But they might not protect your Picasso painting. But so if I borrowed money against Picasso painting, I might, and the banker said, we're going to market to market every month. That's not as good as once a decade.
Mm-hmm. Right.
So when you're thinking about risk, you're thinking about how liquid is the collateral and how frequent is the mark to market, and then how much is the loan to value. And that's how you get to a question of risk and what you should do or not do.
That makes sense.
I'm not saying you have to do it, by the way. You could just sell the Bitcoin highly appreciated for cash, pay the tax, and take zero risk. And look, if the interest rate was 18% and you thought that the economy was going to grow at 4% or 3%, then you would sell. Mm-hmm. And you would take on the debt. So it's a function of interest rates as well, and productivity.